Sensex at all-time highs. What better time than to get Mahesh Nandurkar, India strategist at CLSA, joins us right now on the show. Mahesh, thanks so much. Opportune time to have you. Very good morning. This is Neeraj here. We couldn't have had a better morning. 3 days into the new week, amidst all the talks of carnage in the mid-cap space, we're sitting pretty on the Sensex already. Nifty about 100 points odd away, or maybe just a few points away now. What's the thesis right now as we are approaching the Q1 earnings season?
Hi, good morning, Neeraj. So the Q1 result season is obviously around the corner. We are expecting that, helped by the low base, the YOY performance by the corporate sector should be good. We are expecting close to about 18 to 20% earnings growth. That would probably be the highest earnings growth that we would have seen in the last several quarters. So from the bottom-up perspective, from the corporate earnings growth perspective, things are beginning to improve. So that's a good news. The key source of worry, however, remains, to my mind, the macro and the top-down concerns. Remember that on various macro parameters like the inflation outlook, the RBI rate, the policy rate outlook, the fiscal deficit outlook, the currency, etc., and I would add even maybe a bit of political uncertainty as well. So the macro headwinds clearly stay, which is really the key source of concern for us if we look at the market performance from here on with, let's say, a 6-month or even a 12-month view.
All right, Mahesh, the last time we spoke to you, well, the general idea that we were getting from you was that at this point in time, the bond markets were looking more attractive in comparison to the equity markets. That said, when I'm looking at the institutional flows in India, the outflows from the bond market is much more pronounced when it comes to the equity markets. Can you tell us a little more about how you're reading these clues based on your views on both these markets?
Okay, so just to clarify, when I said that the debt markets are looking more attractive, and I still hold that view, I'm talking more about the short duration debt market. So I'm not taking a call on the bond yields. I think that taking a call on the long bond, a 10-year or a 15-year GSEC, is still a bit risky in my view, because I do see the yield remaining at the elevated level, and there is an upside risk from here on as well. I won't rule out the yields going up further up to say 8.25, etc. So just to be clear, what I meant that time and also what I mean this time as well is that from the next 12-month perspective, I think the class of financial assets that should give maximum risk reward return is the short duration bond. So 1 year, 2 year, 3 year kind of thing.
Right, Mahesh, in that case, let me take your view on what you think about the interest rate trajectory in India. Well, a lot of analysts out there are factoring in at least another rate hike from the RBI. What is your view on this one and the potential impact it can have on equity markets going in?
Yes, so at least one rate hike, I think, is given. My sense is that there will be more than one rate hikes over the next 6 to 12 months, could be even 2 or 3 in my view. And one of the drivers for that decision would not just be what is happening on the inflation front. That is, obviously is the key guiding principle which the RBI follows. But we'll also have to take into consideration what is happening on the rupee side as well. Remember that over the last 3 months, RBI has used up about $25 billion of reserves in stabilizing the currency, and that $25 billion is inclusive of the forward cover. It's not just the spot that I'm talking about. So we have used substantial amount of our forex reserves in stabilizing the currency, and yet year to date INR is the worst performing currency in the Asia region. So there are risks on that side as well. And we have seen, except for China, the other regional central bankers raising rates to defend the currency. Obviously, that's not really the mandate for the RBI, but they will also keep that in mind. So I would say definitely more than one rate hike over the next 6 to 12 months.
Mahesh, in which case, what is the biggest risk to your mind? You outlined 3 or 4 macro factors which could be headwinds. Politics is probably anybody's guess. We couldn't quite know that. But aside of politics, what's the biggest red flag for you right now? Because we are sitting at fresh highs, and you are talking about red flags to the markets currently.
Right. So from the macro front, we have been highlighting the fiscal concerns, the fiscal deficit falling short, and which will probably have some implications on the bond yields, inflation as well. But the single biggest macro factor which is holding up quite nicely as we speak is the inflows into the domestic equity mutual funds. So we have seen some slowdown on that. The second half of last calendar year, we were seeing inflows of around 18 to 20,000 crore per month. That number has now come down to about 10,000 crore, but that still is a very respectable number. And despite this slowdown, a little bit of a slowdown that we've seen in the mutual fund inflows, the markets have still gone up in the last 3 months. And the primary reason for that is the fact that we did not really have any meaningful or a big equity paper supply in the market. So from the equity demand supply perspective, things have still been on the positive side. So my worry sitting at the current point in time is that this demand supply equation might change for worse in the next 3 to 6 months. And the reason for that is twofold. One is that most of the corporates who want to raise money in the current financial year will probably like to get done with that, say by October or November, because from December onwards, the political uncertainties, will begin to play a role. And I don't think, many companies will plan their equity raising at that point in time. So most of the companies will probably, try to, finish the equity offerings in the next 3 to 6 months. And if we continue to see the current level of inflows on the domestic side, and the trend continues on the foreign inflow side as well, my worry is that the equity demand supply will turn for worse, and which will be the single biggest risk for the market in my view.
Interesting. Mahesh, what do conversations with your global clients suggest? Yes, we've seen outflows, and that's not been India specific, but is anybody talking about putting fresh money, big money to work into India or EMs by and large, or is it a sit on the sidelines kind of a mode currently?
See, what has been happening in this current calendar year so far is that the emerging market funds have been seeing some outflows. The US markets has been big outperformer, and to that extent we have seen the flows to the emerging markets, including India, being on the negative side. Obviously the dollar has been quite strong currency as well. I don't think there is any big money waiting in the sideline to come into India at this point in time. But yes, what has happened is that over the last couple of months, on a relative basis, Indian markets have outperformed. And the reason for that is there have been some bigger, I would say, risk or concerns coming up in the other emerging markets like Turkey, Latin American markets, Russia, etc. So as compared to the emerging markets, in general, Indian markets have held up much better over the last 2 to 3 months. So as of now, some of the investors are looking at India as probably a place to hide, also in the large cap space, because there you have several companies like the IT services and the commodity exporters, etc., which are not really linked with the domestic economy, and where the trend has actually been quite strong. So the global investors have been looking at India as a place to hide. To some extent, and within that, it's the large cap and exporters which have been the point of attraction.
Right, Mahesh, you did mention that there's been some strength when it comes to markets and equity markets in the US, and we are seeing substantial moves in the European markets as well. One, what is your assessment of the equity markets abroad, and two, can we expect some amount of, should I say, weakness going in? If that is the case, what impact can it have on India? And how insulated are we from the equity markets at this point in time?
See, if you look at the global developments and the impact of that on the emerging markets and also on the Indian markets, clearly there will be some positive news, there will be some negative news, the market will be volatile, that's there. But we should not lose the sight of what are the bigger trends happening in the global markets. And the bigger trends is that, one, the US Fed has already started raising rates. They have hiked the rates a few times in the last 12 months. Over the next 6 to 12 months, there will probably be another 2 to 4 rate hikes, adding up to 50 to 100 basis points. Also, if you look at what is happening in Europe, the ECB has already talked about their tapering program of the QE. So the interest rate scenario globally has been towards a trend of going up. Also, the global liquidity conditions are also slowly tightening. So that is really the big macro trend globally that we need to keep in mind, which will keep the equity valuations under pressure globally and certainly in the emerging markets, including India.
Right, Mahesh, recently we had the MSPs announced by the government. What are the other policies that are likely to influence markets and economy in general, especially keeping in mind that we are less than a year away from the general elections?
And actually, if I can just add a follow-up out there, Mahesh, on the MSP itself, you guys have been writing about this now for the last 6 to 9 odd months, if I'm not wrong. How big an impact for the rural sensitive stocks would this be, if at all?
Yes, so as you rightly mentioned, keeping the elections in mind, there has to be some focus on the rural economy revival, and which is the right step that the government has been taking. We know that the rural wage growth has slumped to an all-time low of close to around 3 to 4%, and that definitely needs to go up from the political perspective. So MSP hike has been one. We've obviously seen a few announcements at the state government level on the farm loan waiver. And going forward, I think there will be many other programs that will be taken up, such as, so even when we talk about the roads program, mind you that nearly 50% of the capex for a road project goes into land acquisition. And that essentially is money going into the hands of the farmers or the landlords, basically most of which goes back into the rural economy. So my sense is that it will be a combination of several of these MSPs, farm loan waivers, road program, and the other initiatives, such as obviously the government has been talking about the medical insurance program. Let's see how that rolls out. There are certain states which have talked about certain innovative schemes like certain 4,000, 5,000 rupees per acre per crop as the subsidy and so on. So expect this kind of policy framework to remain both from the central and from the state government side over the next 12 months or so. And naturally, this should have a positive impact on the rural facing industries and the companies. So the staples companies, the two-wheelers to some extent, also on the four-wheeler side, including the tractor companies and so on, should clearly be the beneficiaries. There will be some consumer durables as well, like the electricals or the fan fitting companies, etc. So some of those low-ticket items of consumption should definitely see some fundamental improvement in the growth outlook.
FMCG, Mahesh, see a leg up? I mean, the stocks are trading at valuations which are abnormally high, higher than their averages, higher than probably valuations that they have traded in the best of times in the last 8 or 9 odd years. But this should give a leg up to earnings for sure. What do you do out there? It's a bit of a tricky call.
Oh, absolutely. So you've hit the nail right on the head, especially on the staple side. The multiples are at an all-time high. So there, one can take a relative value approach. So we definitely see relative value in tobacco stocks, for example, which are trading at almost 40 to 50% discount to the leading FMCG companies. So that is certainly a space to watch out for. And similarly, we can see some value based buying that can happen on the tractor side, and there are a few other stocks on the two-wheeler side as well, where we can see the relative value.
All right. So in that case, Mahesh, I want to move on and address the technology sector as well. Well, in this case, we've started to see the largest company in the IT sector, the Indian IT company come through with good earnings. Does this set the tone? And I'm not talking about TCS specifically in this case. I want you to give us a better picture of what we can take from the earnings when it comes to the entire sector as a whole. Has it turned a corner, and can we expect better things to come from the entire sector?
Yeah, so the thing is, rupee weakness is definitely a tailwind for sectors like IT and pharma. And also the result season has off to a very good start, and the commentary from the from the top two companies, in fact two of the largest companies that have already reported, clearly shows that there seems to be some signs of revival in the US BFSI space, which is actually one of the largest business verticals for most of the IT companies in India. So once again, one can look for relative value within the IT space as well. There are certain large cap stocks as well, which are trading at a significant discount, and some kind of a value buying should be done there as well. On an overall basis, we continue to maintain a neutral stance on the IT side, but the exporting sector that we are very, very bullish on is pharma and healthcare. We are actually recommending a double overweight on pharma at this point in time. And the reason, apart from obviously the rupee related tailwind, is that the worst in terms of the news flow seems to be behind. We are slowly beginning to see the pricing pressure, which has hurt the performance of the pharma stocks, stabilizing, and that's also in the base. So from the year-on-year comparison perspective, FY19 should be a good year for the pharma sector in terms of earnings growth. We are expecting more than 20% earnings growth, and it's also a sector which is not that well owned in the institutional space. And keeping in mind that the news flow seems to have turned the corner, we remain optimistic, much more optimistic on pharma than IT at this point in time.
Right, Mahesh, I just want to stick with IT for one more question. There is a substantial difference between the large cap, the leaders in the information technology sector, and when it comes to the relatively smaller ones, they're all doing their own thing, creating their own niches. So when it comes to the relatively smaller ones, how would you go about picking the right stock? What are the properties and perhaps some other factors that you'd keep an eye on, look out for when it comes to picking stocks in, well, the broader IT sector?
See, in the broader IT sector, I would say that one doesn't really need to go down into the mid-cap space just for the sake of valuation, because even within the large cap space, there are large valuation differences. And so even if you look at the large four IT companies in India, there are a couple of them which seem to be trading at a relative value. So if you're looking at valuation perspective, you can find enough value in the large cap space as well. On the mid cap side, obviously, every company has its own niche, and I can't really get into the company specific details here. But I would just reiterate that the large cap space also offers decent opportunities at this point in time.
Mahesh, we started off this discussion with a quick snapshot of the earnings. The question that I have is, at the end of Q4, I distinctly remember almost everybody saying that the earnings recovery in FY19 will be back-ended. Most of the sell-side heads of research or strategists are now penciling in an 18 to 20% growth in Q1 itself. Does this set the tone, one, for the earnings season at large for FY19, and two, does it improve the sentiment in the broader market if we indeed clock in about a 20% growth? Because then we're not talking about a back-ended earnings recovery. We're talking about the earnings recovery happening in Q1 itself.
Look, the Q1 has the benefit of a very low base. Remember that we entered into the GST framework on the 1st of July, and therefore the first quarter of FY18 was severely impacted for several consumer and some of the mid-cap companies and so on. So clearly we are also seeing the benefit of the low base helping the YOY comparison in the first quarter of FY19 because of that GST impact. I would still say that the second quarter may not be as good as the first quarter, but yes, eventually things will begin to improve as we go towards the second half of FY19. And one of the big segments that in the domestic economy where we expect to see a significant improvement is the real estate space, the property space, where we see that the things have already bottomed out in my view, and there are some small pockets where we are seeing an encouraging sign of the demand recovery. Also, from the listed real estate space, they not only benefit from any potential improvement in the property markets in general, but also the fact that RERA has driven industry consolidation, and we are seeing market share gains for the larger players. Also, their cost of funding is much lower, etc. So the listed players in the real estate should also see the benefit of that. But yeah, but that's obviously a much broader trend in the economy in general, which should help improve the the bottom up, the economic growth perspective from the second half FY19 onwards.
Interesting. Mahesh Nandurkar, we could actually carry on, but I know time doesn't permit it. But thank you so much for taking the time out and speaking with us today. Really appreciate it.
Thank you very much.
That's an important market voice on an important day when the markets or the Sensex has nudged record highs as well.